Hi viewers, Namaste. Many option traders who come new to the market have one thing common as a question. If we are bullish on one script, should we buy call option or sell a put option? On the other hand, if we are bearish on any script, should we buy a put option or sell a call option? Also, see these two option chains. Both have same expiry, same strike price and almost similar spot price too. But if you observe carefully, there is so much change in the option price, that is option premium. Finally, did you face this situation at any time? You buy an option and spot price is moving in your favorable direction, but even after that you face losses, particularly in intraday orders. Faced or not? The main reason common for all these situations is implied volatility, and that is the topic of this video. Basics of implied volatility. So, welcome to the world of GetTrading. Implied volatility. Two words, implied and volatility. We had already made a video on volatility, but to explain it in simple, volatility is the range and speed of price movements. It shows how much quickly the stock has moved up or down. Okay, in that video, we have seen the volatility which is calculated from the previous data. In stock market terms, it is called as historical volatility. Then, what is implied volatility? The volatility which is expected or predicted to have in future is nothing but implied volatility. So simple. Think it as forecast of future movements in price. So the volatility markets are implying about future is this implied volatility. Since this is calculated in options market, it is majorly used in options market itself. But this can be decoded to be used in sensing spot market volatility too. Okay. Additional to these two volatilities, there is one more called VIX, which we can discuss in some other video. Now, before going into actual subject, tell me one thing. When you have some excess cash in hand and if your close and trustable friend comes to you and asks for some loan, will you not give him the money? As he is your trustable friend, you will charge some nominal interest, right? But if I come to you and ask money, you may not be interested in this transaction as I am a complete stranger to you. But if there is some pressure on you that you should lend money for sure, you will lend me for some heavy interest, more than your friend. Why? Because there is risk and uncertainty involved here. You are charging high as there is more chance of you losing money, right? Now, let us see this similar situation in stock market terms, particularly in options. When does an option buyer gets profit? When the underlying asset price move away from the strike price. Of course, plus or minus premium based on call or put options. If the price stays where it is, who is gonna be profited? Option seller. Yes or no? Next step. Options premium is decided by option seller mostly during option writing. So, tell me now, if this implied volatility is moving higher, then can we say that option buyer has more chances of his contract going in the money? If this sentence is easily understood by you, congrats, you are rich with basics in options market. But if you still have some doubt, please consider watching our futures and options playlist fully one by one. Link can be found in the I symbol above and the description box below. Okay, we now know that if implied volatility is moving higher, then contract closing in the money chances are high, which means option buyer profiting is high, which in turn means chances of option seller losing money is also high. Yes or no? If we combine this concept with the concept we saw before, that is the lending one, if implied volatility is high, option seller will demand high premium than before because of risk or uncertainty involved more. That means, can we say that more the implied volatility, more the premium? Similarly, for low implied volatility, option seller is risking very less compared to the previous one and so may not demand much premium. So lower the IV, lower the premium. Understood? Okay, before going to next concepts, let us quickly see how is this IV calculated. This is formula which is of course complicated. It uses Black-Scholes model for calculation. Let us not check the full complicated formula but just see what input it takes. Things which impacts option premiums are these itself. spot price, strike price, time to expiry, interest rates, etc. These are all static or changes statically, but this implied volatility, which dynamically changes, is what influences premium most of the times. So, if we try to reverse engineer this formula, IV can be calculated from these inputs itself. So, can we say that IV changes represents the changes in premium and that changes in IV can be taken as a tool to predict premium? Yes, of course. Okay, next is, before discussing the uses of this IV, let us see where to track this easily. Elsewhere, it can be checked easily on option chain in NSE website. See, this is Nifty 50's option chain of 28th May expiry contract. This is IV, that is implied volatility. This IV is separate for call options and put options. Let us check the historical volatility of Nifty. How? In the same information under Nifty snapcode. On the other information, click on this annualized volatility. See, 64.95. This is in terms of percentage and this is the value considering one standard deviation. This standard deviation is a vast subject, but let us see only one thing of it. What is standard deviation in volatility? See, 9200's implied volatility is 34.27 and this is value considering one standard deviation. That means Nifty can move between 9200 plus or minus 34.27% within 1 year, that is 12,352 to 6,047. And this happens for one standard deviation. One standard deviation means this probability of closing between these two prices is 68%. If you remember the same concept used in Bollinger Bands, the to and fro movements considering one standard deviation has 68.2% chances and two standard deviation considers 95.4% chances. But markets take this one standard deviation into consideration for analysis and we too can follow it. Okay, this IV can also be used to predict the probability of contract closing in the money before expiry. Let us see how is it done. Procedure is, we should take two strike prices of at the money contracts and record the IV of calls and puts of these strike prices. Then take the average of this IV. The average here is 36.8, round figure. Okay, as said before, this is IV taken for annual, that is 365 days. Now, today is 8th and expiry is at 28th. So, there is only 20 days left till expiry. So, can we check the IV only for 20 days? Yes, by the formula. Let us see from this itself. Square root of 20 divided by 365 multiplied by this 36.8. So, 8.61%. This means for current price of 9200, the volatility for 20 days is 8.61%. And so, this Nifty can move 792 points up or down. One thing more to keep in mind is this IV keeps on changing from time to time. So, market perception will also be changing from time to time. But as of now, this contract by May 28th can move between 9,992 and 8,408 and close in between. How much is the probability? 68%. So, you can keep this info on back on your mind and use this as confluences to your analysis. Next use. We can also use this IV to select the strike prices of options. How? Considering speculator's point of view, tell me again, when does option buyers profit? When the current price, that is premium, moves more than the premium at which he bought the contract. In the same way, option seller profits when the current premium is less than the premium he got, right? So, if you follow this IV daily, tell me one thing. If this IV is increasing, do you think buying option is good or selling an option is good? To be more precise, if you predict an upside movement in a scrape, will you buy a call option or sell a put option? That depends on option premium. If call option premium is less, we can go long in it. If put option premium is more, then we can go short in it. Making sense? Okay, we have already agreed that next to spot price, the other thing which dynamically changes in an option premium is IV. So, if you observe that IV is increasing, you can predict that premium will also be increasing, and so you can be a call option buyer. Similarly, if you observe that IV is decreasing, you can predict that premium is gonna decrease, and so you can become put option seller. Hope you have understood it. Majority of traders generally trade in Nifty or Bank Nifty options regularly. So you can easily analyze, be updated and notice the movements in IV and track them for better analysis. By doing this, you can easily spot the increase or decrease in IV and thus can add this analysis as confluence too. One interesting thing is IV increases with much acceleration in bear market than bull market. Just observe in next consecutive runs. Next step, let us go in depth on the same analysis. This IV is cyclic, that is, it moves in a specified range. So, can we do like this? Keep the maximum and minimum IV values in mind, and whenever the IV reaches maximum value, from history data, we can predict that IV may now fall, and so premium falls. So, what can we become now? Option seller, right? Because premium gonna fall. Sell high and buy low concept. Of course, if all other factors are constant. In the same manner, if IV reaches historical minimum value, you can predict that IV will not fall more than this and so you can become an option buyer. Call or put depends on the overall market conditions. Buy low, sell high. Okay, finally, I did not see much screeners or sites which records this IV. I will search well and update you soon. But if you are okay with this logic, search in Google Implied Volatility Low and High Scanner NSC and open any website of your choice. Topstockresearch.com. Open this. So this is put option screeners of IV. Here select high implied volatility. So these results are of put options which have high IV. So if you are bullish on some stocks and if those are visible here, you can consider analysis of shorting put options. In the same way, you can select low volatility or call options, etc. You can screen combination of these inputs as well. Okay, before closing, see this important note. The one thing you must strictly keep in mind is this implied volatility signals you the strength of movement in a particular script but not the direction. But anyways, we can use this analysis in combination with other analysis too. In future, we will be discussing about some option strategies which are purely based on volatility rather than direction. Combination of calls and puts, etc. You will for sure get to know the value of tracking IV when you complete those videos. So be sure that you don't miss our next videos. How? By subscribing to our channel and pressing the bell icon. One more thing. If you are looking for a good stockbroker with excellent trading platforms, less brokerages, etc., Fire Securities is the one we recommend. If you at any time consider opening your account through us, please click on the link in the description box below and submit your details. Our Fire's representative will call you and will open your account. Please like, share and comment on our video. Have a happy, safe and profitable trading. Jai Hind.